Your vision is our mission. Welcome to myfinance, one place roadmap solution for financial freedom. Note, this is a certified course. Make sure to follow very simple steps to get yourself certified from myfinance. Firstly, complete all the content on the playlist. Secondly, attend the feedback and the knowledge test. Thirdly, you will be mailed with the certificate of learning to your registered mail ID. Make sure to like, share, and subscribe so you never miss out on healthy content from myfinance. Note, this is a continuation of the previous video. Make sure you have to check that out before you hop onto this one. Happy learning! Shrey has watched our first video on investing, and now Shrey is having a basic knowledge of the market. But Shrey is still confused, like what's the first step with where can I start and how do I start? So Shrey is really confused and he asked us, how can I start? The first way he could start is by having to invest by himself, which is called do-it-yourself investor. At this is a place where an investor independently analyzes the stock, interprets the market value, makes the trade on himself. The steps required in this is you need to have a DEMAT account, trading account, and a savings account linked to your DEMAT account, which you can allocate to the stock market and make the calls. On this case, you're going to earn the profits, and then you're just going to pay the minimal amount of brokerage charges. But all the analysis and all the study should be done by the individual. You're not going to get help from anyone. So do it yourself traders, if you have enough time to study the market, then this is the best option for you. But as you all know, most of us are having full-time jobs or are not available. So what can they do? You can get your money invested by professionals. How do they do it? Well, there are different types of private equity people and hedge fund people who manage your money for certain amount of fees. Well, hedge funds and private equities are only for HNIs. How can a middle class go for it? A middle class person can go for it by the term called mutual fund. A mutual fund is a scheme where a group of people deposit their money into a scheme which is professionally managed. And once the professional manages your money, your portfolio is getting managed by professional, and the professional invests the sum of money in the sum of the selected stocks on the basis of his research. The third type, which is not that popular but is really trending these days, is called robo advisory. What are robo advisory and how is it better and different from mutual fund? Robo advisors tracks the market and finds the best investment opportunity and diversifies your portfolio and puts eggs into different basket. What this usually does is this diversifies your investment into in the large scale of the market and lowers your risk. So in robo advisory, you have a safe investment into many diversified funds. Along with that, you are going to make stable return over the long period of time, even at the short period of time. I consider robo advisory as the future, as your investment is safe, diversified, and generates good return. Now I'm going to talk about the exchange traded fund. An exchange traded fund is a type of investment fund in the exchange traded product. They are traded in the stock exchange. ETFs are similar in many ways to a mutual fund, except that ETFs are bought and sold throughout the day on stock exchange. So exchange traded funds are a consolidations of stocks, bonds, mutual fund, just like any other mutual fund, but these funds are traded publicly on the secondary market in the stock market. Here you can make a purchase for a day and there is no exit load which we have it on mutual fund and no expense ratio. So Shrey asks, are ETFs a good choice? Exchange traded funds have number of features that can make this investment vehicle an ideal for young investors with small amount of capital. For one, the exchange traded funds makes it possible to build a diversified portfolio with relatively low investment and generate the decent amount of returns. Next question is, are ETFs better than stocks? There are few advantages of ETFs which is concerning to the successful strategy known as passive investing. One of them, you could buy and sell stocks, but ETF is like you can buy and sell a group of stocks in an individual stock. That's how ETF is advantages. Now we're going to talk about how do robo advisors calculate. So robo-advisors use the calculation called risk calculation or riskometers. They design your portfolio on the basis of your age, risk tolerance, and returns. In short, if you are young and your risk then your risk tolerance is going to be high and your returns are also going to be high. So robo-advisor is going to pick up some high aggressive stocks for you, which is going to beat the market in the long run as well as the short run. Whereas if you're old, your risk tolerance is low, and then your returns will also be low. So robo-advisor will by default pick up some bonds and then a neutral performing stock or stocks which are safe, but safe and generating decent return. This is how robo-advisor determines your portfolio on the basis of the riskometer calculation and assigns your portfolio with the certain stocks and bonds. How are robo-advisors different from mutual fund? Well, mutual fund means a professional managing your money on behalf of you. A group of people giving their money to a professional to manage their money's mutual fund. Now, robo-advisors does the same thing, but here there is no professional involved. It's just the robot who determines the value. There's a stat that in mutual fund only 1% of the fund managers can beat the market with the expense ratio. Whereas robo-advisor have low fees, accurate calls and strategy as it's computer based, and third is anyone can start investing. In mutual fund there is high expense ratio and high management fees, where robo-advisors charge slightly lower and they provide more accurate calls and strategies for future. Finally, Shrey is ready to enter in the market, and there are some of the guidelines which he needs to follow. Shrey shouldn't invest the money which he would require any in 5 years. Then the next thing is he shouldn't invest. He shouldn't invest before he has established financial foundation, which means no high interest debt or no acquainted amount incurred or 6 months of living expenses covered. Third is he need to automate his investment, and fixed amount of investment of his paycheck every month is supposed to go to the investment. And then Shrey is ready to enter the investing market. And this is how Shrey can leverage his investment 20% of his paycheck and make great amount of returns by the power of compounding and the snowball effects.
Well, we have come to the end. Thanks for watching this video. Make sure to like, share and subscribe so you never miss out an update from myfinance. Make sure to complete all the videos in the playlist, as you know that this is a certified course. Make sure to follow us on Instagram, LinkedIn and Twitter so that you get out valuable content over there too. Happy learning!